With internet penetration and smartphone use climbing, the number of online shoppers is growing at a double-digit rate. Forecasts estimated over 500 million African e-commerce users by 2025. That's about 40% of the population, reflecting explosive consumer demand. Yet this boom masks a paradox. An alarmingly high share of cross-border orders simply never arrive.
Welcome to the Deep Dive. I'm Wendy.
And I'm John.
We're both staff here at WeWire, and today we're taking a deep dive into that very paradox. This week, we're unpacking a key report that explores why so many cross-border orders in Africa are still failing to reach their destination, despite this incredible e-commerce growth we're seeing.
That's right. Our mission today is to really understand the complexities behind this return-to-sender phenomenon, drawing crucial insights from a recent weekly Stay Wired report. It's a fascinating look at the challenges, but also, the immense potential of Africa's digital marketplace for you. So we've highlighted those pretty impressive growth numbers for Africa's digital marketplace, over 500 million e-commerce users expected by 2025.
Yeah, huge numbers.
But as you just pointed out, beneath that exciting surface lies a significant paradox, one that industry observers are calling return to sender.
It's truly a significant plot twist in an otherwise incredible growth story. I mean, while the numbers of online shoppers are just soaring, an alarmingly high share of cross-border orders simply never make it to the customer.
Never make it.
Yeah, we're talking about situations where, in parts of Africa, over 90% of cash-on-delivery shipments are rejected.
90%.
90. In practice, only about 60% maybe of parcels are successfully signed off by customers. That means roughly 4 out of 10 shipments fail to complete.
4 out of 10.
And it's a trend that actively threatens to, well, undercut the very growth of online retail across the continent. It's a serious problem.
90% rejection for cash on delivery. That's almost unimaginable in other markets.
Yeah.
What's fundamentally driving this paradox? Is it mostly consumer behavior, or are there bigger systemic issues at play here?
It's definitely a combination, but the payment gap is, well, it's a huge piece of the puzzle. You see, nearly half of African adults lack a formal bank account.
Half the adult population.
Exactly. So this means cash and mobile money dominate payments. E-commerce sites, trying to be inclusive, often rely on cash on delivery or SIACO. That's where buyers pay when the package actually arrives.
Right, and in theory, SIAD is meant to build trust, isn't it?
Yeah.
You only pay if you actually receive what you ordered. Seems sensible on the surface, but what happens in practice?
Well, in practice, it causes huge losses. Couriers deliver goods without any guaranteed payment, and recipients can simply refuse the parcel on arrival.
For any reason.
Pretty much, yeah. Change their mind, don't like the look of it, whatever. And that logistics study we mentioned found refusal rates on African seed deliveries above 90% in some areas.
Wow.
Think of the massive wasted shipments and resources, fuel, the courier's time, inventory costs. It all adds up.
Okay, here's where it gets particularly interesting and, frankly, a bit disheartening. This problem is compounded by a high incidence of bogus orders.
Ah, yes. The fake orders.
Right. Without the hurdle of needing a prepaid credit card, some individuals apparently place orders with fake names or addresses, maybe sometimes just out of curiosity or, even maliciously. Call center agents in many African markets note a high percentage of fake or junk orders arriving with just incorrect delivery details.
Exactly. And this raises a really important question for businesses looking to expand. How can they possibly thrive when this payment gap and the C-aid model fuel such mistrust and, well, junk orders? It means only a minority of intended sales actually turn into successful deliveries.
Yeah.
It's an almost impossible environment for sustained growth, really.
Okay, so that's the payment side. But beyond payment, the physical journey of a parcel faces significant hurdles, too. Things we often take for granted in other parts of the world.
Oh, absolutely.
We're talking about poor infrastructure throttling deliveries, rough roads, often impassable during rains,
Nightmare.
and a widespread lack of formal street addresses or postal codes in much of sub-Saharan Africa.
And this makes last-mile delivery, that crucial final leg of getting the package from a local hub right to your door, extremely slow and prone to errors.
So finding the actual person is hard.
Very hard. An analysis found that average e-commerce delivery times in sub-Saharan Africa stretch 10-14 days.
10 to 14 days.
Yeah, compare that to just maybe 2 to 5 days in developed countries.
Yeah.
Imagine, rural parcels might never arrive if a courier can't even find the right village.
Right.
And even urban slums often lack formal house numbers. On top of that, tracking systems are often pretty limited, so once a package leaves the dispatch warehouse, both the sellers and you, the buyer, can kind of lose visibility. You just don't know where it is.
It really puts things into perspective, doesn't it? We often take for granted just typing in a postcode and expecting a delivery, maybe even the next day. Imagine the daily logistical puzzle these couriers face, trying to navigate areas without a clear address system.
It's incredibly complex work.
And all of this translates directly into delays, frustration, and ultimately more returned packages for you, the consumer waiting at home. Okay, so payment issues, infrastructure issues. Then there's the border. For cross-border orders, complex customs procedures and high import costs add still more roadblocks, literally, sometimes.
That's right. Many African governments levy steep tariffs, often as a way to raise revenue. For example, buyers in Nigeria might pay an additional 20–30% in duties just on an imported smartphone.
20 to 30% extra.
Yeah, just in duties. So these extra charges significantly discourage cross-border orders, obviously, and they inevitably delay clearance at the border. Plus, border processes themselves are notoriously slow and often quite opaque.
Hard to navigate.
Very. The African Development Bank has reported that transport and border delays can account for as much as 40% of the total logistics costs in some regions.
40%. Just delays.
Just delays. Think of those queues of trucks you see at busy crossings, like Bight Bridge between South Africa and Zimbabwe. They regularly last for days, sometimes even weeks.
Each wasted hour at a border isn't just an inconvenience. It means price inflation for the consumer, spoilage of time-sensitive goods, and, all too often, another canceled delivery. It's a huge economic drag on the whole system. Okay, so we've painted a picture with some significant challenges. But despite these issues, it's not all doom and gloom, is it? There are a number of truly innovative solutions taking root, signaling a more promising future for African e-commerce.
Absolutely. It's not static. African policymakers are actively pushing reforms to smooth out trade. The African Union's 2030 Digital Transformation Strategy, for example, explicitly aims to create a continental digital single market.
Single market.
Exactly. Focusing on harmonizing e-commerce laws, integrating mobile money systems across different borders, and even improving those postal addressing systems we talked about. Likewise, the AMCFTA, that's the African Continental Free Trade Area negotiations, include vital e-commerce provisions. Things like rules for e-signatures, data flow rules, and even exemptions on low-value e-shipments to make small transactions easier. These are pretty fundamental changes being discussed.
And are we seeing actual results yet? Or is it mostly plans?
No, we're already seeing concrete results from these efforts in some places. Some governments are digitizing customs procedures. Rwanda's electronic single window system, for instance, reportedly slashed clearance times from 11 days down to under 24 hours.
11 days to less than 1.
Yeah, massive improvement. And international finance agencies are funding these smart border projects, installing scanners and common IT platforms to cut delays at key crossings. So, yeah, there's real progress happening.
It's incredible to see that kind of progress, that kind of leapfrogging potentially.
It really is.
So what does this all mean for you, listening, and for the future of commerce on the continent? Africa's cross-border e-commerce is truly at, a crossroads. The potential prize is immense, connecting 1.4 billion people to a market estimated at over $1 trillion.
Huge potential.
But that prize is only attainable if these systemic hurdles, the payments, the infrastructure, the borders are actually cleared.
Right. And development agencies note that a truly frictionless AFCFTA, if it's fully implemented, could lift something like 30 million Africans out of extreme poverty just by boosting trade.
30 million people.
It's a huge number. But achieving that vision requires both smarter borders and better last-mile networks. If governments can harmonize tariffs and digitize customs, and if companies invest in the necessary infrastructure and ways to build consumer assurance, then this current trend of failed deliveries, the return-to-sender problem, can indeed be reversed.
Yeah, as one analysis we looked at concludes, by resolving these issues, Africa can create a more vibrant and inclusive e-commerce sector that benefits businesses, consumers, and the economy in the whole. It's a really powerful vision.
It is. But until then, as the report puts it, too many orders will just keep coming back.
Okay, that was an incredibly insightful look at the complexities and the immense potential of e-commerce across Africa.
Yeah.
Now, let's zoom out just a bit for our broader weekly Stay Wired recap. We'll draw some summaries from this week's market movers from Wire Times and other key updates you should probably know about.
Okay, sounds good. So, starting with some global market movers this week, we saw Canada's trade deficit narrow, which was interesting, mainly driven by strong exports over to the US.
Mm-hmm.
This might suggest some surprising resilience in the Canadian economy, perhaps signaling stronger North American trade ties, even with all the global uncertainty. On the other hand, Germany's economy forecast got cut. Seems tariffs are weighing on growth there. It's kind of a stark reminder of how protectionist policies can really impact global trade flows. Maybe echo some of those tariff challenges we were just discussing in Africa.
Yeah, definitely related. And focusing back on Africa, one significant development was Zimbabwe securing a breakthrough agreement to start exporting blueberries to China.
Oh, interesting. New markets.
Exactly. That's fantastic news, showing how new trade agreements and market access can create real economic opportunities. On a more sobering note, though, hunger is unfortunately reported to be growing in Nigeria, partly due to aid cuts.
Tough situation.
Yeah, it highlights the ongoing humanitarian and economic challenges that can still impact consumer behavior and market stability, even while the digital economy grows.
Mm.
Also, Uganda's borrowing about $400 million for agriculture and transport infrastructure.
Okay, infrastructure investment.
Key. And ArcelorMittal's talks to sell its South African unit seem to have stalled for now. So a mixed bag of news across the continent.
It really shows how these broader market dynamics, everything from international trade resilience to, sadly, humanitarian concerns, indirectly shape the environment where African e-commerce is trying to thrive.
Yeah.
The solutions we discuss for e-commerce, they don't exist in a vacuum, do they?
Not at all. Now, turning to the currency markets, the FX corner. Let's look at how some key African currencies performed against the US dollar this past week.
Okay.
The Ghanaian Cedi, the USD GHS pair, well, it's slumped again, down about 5.02% week to date and month to date. That extends its year-to-date slide to nearly 40% down. Negative 39.27% to be exact.
Wow, 40%.
Yeah, making it the region's worst performer. Seems like persistent dollar demand and limited FX inflows are the main culprits there.
Right.
The Kenyan shilling, USD keys, actually edged up slightly, 0.08% for the week and month, a rare gain. Year-to-date performance is just slightly positive at plus 0.12%. Looks like lower import demand and stable central bank liquidity helps support it a bit.
Okay, bit of stability there.
A little bit, yeah. The Nigerian Naira, USD and GN, weakened, though, by about Mainigad's 0.62% week-to-date, month-to-date. Again, sustained dollar demand from importers seems to be the story.
Familiar theme.
The South African Rand, USDZR, lost 0.44% this week, bringing its year-to-date losses to about Mainigad 5.57%. Yeah. General risk aversion in markets and maybe weaker commodity prices weighing on it.
Okay.
And the West African CFA franc, USDXOF, was nearly flat this week, down just Mainigad's 0.06%.
Yeah.
But because it's linked to the euro, it actually shows a plus 4.08% gain year-to-date against the dollar.
Right. That euro link provides some stability against the dollar sometimes. And globally, we saw shifts too, of course.
Yeah.
The British pound against the dollar, GBP USD, fell about 0.58% this week. That extended its recent losses as softer UK economic momentum seemed to weigh on sentiment. Still up for the year, though, plus 4.35% year-to-date.
Okay.
The Canadian dollar, CADOSD, weakened about 0.5%, 0.51% for the week, seemed to track lower oil prices and maybe a cautious outlook from the Bank of Canada on rates. But like the pound, still solid year-to-date gains, plus 5.11%. The Japanese yen, JPY-USD, dropped over 1% this week, 1.03%. That was its steepest weekly loss in about a month. Seems rising U.S. yields undermine the yen's usual safe haven appeal.
Okay, yields driving that.
Yeah. And finally, the U.S. dollar against the Chinese yuan, USDCNY, the dollar gained about 0.15% this week. Looked like fairly light intervention from the PBSC, China Central Bank, and maybe some seasonal dollar demand played a role. But the yuan is still stronger against the dollar for the year, showing about a 3.97% year-to-date gain.
Interesting movements all around. Okay, let's quickly touch on commodities. What happened with oil and gold this week?
Well, in commodities, it was kind of a mixed bag for energy and precious metals.
Okay.
Oil, Brent crude, initially rose about 1% to near $68.15 a barrel. WTI gained similarly to around $64.68. That seems spurred by intensified airstrike activity in the Russia-Ukraine conflict and maybe a weaker U.S. dollar early in the week.
Right.
But that was fleeting. Prices then reversed and slid more than 2% midweek. OPEC Plus was deliberating production increases, which seemed to put downward pressure. That brought Brent back to around $67.54 and WTI to $63.91 by midweek. So up, then down.
Volatile. And gold.
Gold, by contrast, experienced a really strong rally. It opened the week already at 4-month highs, then quickly crossed the $3,500 per ounce threshold.
3,500, wow.
Yeah, big number. Seemed buoyed by mounting speculation about Federal Reserve rate cuts coming and that softer dollar we mentioned. By midweek, it surged even further to hit record highs, exceeding $3,529 per ounce.
Record highs for gold. Okay.
Yeah, quite a move.
All right, finally, let's wrap up with a quick look at some of the week's most active stocks for our investment ideas segment. Now remember, this information is just for informational purposes only. You should always do your own research or consult a financial advisor before making any investment decisions.
Absolutely. So just a few examples that saw a lot of trading volume this week. NVIDIA, ticker NVDA, was around $164.92. It currently has a strong buy consensus rating that's in the technology sector.
Okay.
NIO Inc., the electric vehicle maker, ticker NIO, was trading at $3.90. It has a buy rating that's in consumer discretionary. American Airlines, AAL, was at $12.22. It was actually down about 5.66% on the week, but still holds a buy rating from analysts in the industrial sector.
Interesting.
Apple, AAPL, trading around $207.22, also with a buy rating in technology. And Tesla, TSLA, was at $346.46. It was down about 3.34% on the week and currently has a hold rating in consumer discretionary. So a mix of moves even among the most active names.
Definitely a mix. Well, what a comprehensive look at the week's economic landscape, from the real intricacies of African e-commerce challenges and potential all the way to those global market shifts in currencies and commodities.
Yeah, I feel we covered a lot.
We really saw how a thriving digital market, like the one emerging in Africa, can still face pretty significant friction when it comes to the physical delivery side of things.
And this raises, I think, an important question for you, the listener, to consider. Given the vast potential for economic uplift in Africa through e-commerce, we talked about lifting millions out of poverty, and the clear path to solutions that seems to exist, how quickly can these reforms and investments truly transform the daily lives and opportunities for hundreds of millions of people across the continent?
That is a powerful thought to leave you with. Thank you so much for joining us for this deep dive and the weekly Stay Wired recap. We hope you feel a little more well-informed. Until next time, stay wired.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.